Recessions are difficult to predict with precision, perhaps in a fundamental sense, but with today's central bank intervention, it becomes very difficult to assess the truth of what's going on. There are, however, some very telling indicators which smack you right in the face with a shocking blow of reality. The charts you will see are undeniable. You came here for the truth. Today we are going to look at these indicators of the stock market. I want to begin with the S&P 500. This one is a little different take on the index itself because it's indexed to 100. And what we are doing here is comparing the two previous recessions to the current one. Now, you may not be able to see the font, but at the bottom here we have the blue line, S&P 500, that is 96 to 2000. The yellow or gold line is 2004 to 2008. And then the orange line being 2014 to present. And the numbers across the bottom here are the trading days. Okay? So think about this for a second. The two previous instances, we had nearly an exact pattern, I mean, give or take, of what has happened right now in this current state. And both occasions, we had a dip afterwards. Okay? Both times. Now we're heading into this exact moment where the stock market has been rising and rising. Okay? Very clear. The same thing occurred both times previous. However, in the coming months, very, very soon, we will see a decline. Now, that's what the chart is saying, okay? I'm not saying that. That's what this particular chart is saying, and it's very, very telling. That's the S&P going back 2 times previous, and it is, you can't deny it. In the chart, whether or not that will happen, I don't know. Now, is this the only chart that's been showing that? No, not at all. I'll show you a few more in just a second here. Let's go on. The US yield curve slope flattens prior to recessions. And this is yet another indicator when we see the Treasury yields doing the same thing they have done before, many times before. Look at this. So the gray, imagine the shaded area being the recessions, and every time a decrease in the yield curve brings on a recession. Okay, that's where we're headed currently. Look at this. It heads downward, it heads downward, heads downward every single time previous, sometimes heading into the negative, not every time. Every time this happens, there's a recession that follows. I mean, look at it. This is shocking to me that every single time it happens, this occurs. Now, was the Fed around in the previous recession there to stop it from happening? Well, yes, of course, but they couldn't do that. Crash happened. What happened previous to that? Well, the Fed was there. Central bank intervention was there. Not to this degree we have today, obviously, but they're still there. The general, structure is still there. Yet, we had the same problems. And here we are right now in one of the, I believe it's now the 3rd longest expansion in history. So it's overdue by any means. But look at this. I mean, just another indicator to pile up on top of the rest. And these are similar ones here. Based only on the yield curve, recession odds elevated in the next 12 months. We're looking at the probability here, 33%. That's what they're suggesting here out of Deutsche Bank. Okay, that's not me saying that, 33%. I don't know when it's going to come because, look, if they print enough money, you can push this stock market higher. Give the incentives to the central banks and they will buy. But the consequences, of course, are untold. This is yet another instance of this. And again, you can see that previous just before the shaded area, you see this rising and rising, and what we have obvious. It's hard to really look at these though. I mean, trying to predict when the recession occurs, they're generally never accurate. And of course, closer and closer to that moment, they seem to know everything all of a sudden. It's those who have the foresight to predict it in advance and be ridiculed for long periods of time before it actually occurs. That's what I really like to see. And sure, recessions happen all the time. We're overdue. That's just a simple matter of fact. Risk that unemployment rate falls rapidly. And this is based on this forecast. And here, what we're looking at with flat productivity growth or with baseline forecast, again, a similar situation. Every single time they have the, they lie to us anyway, but showing that unemployment declines, it seems to reverse course and things end up getting bad very fast. This one here is interesting as well. Fed policy could tighten enough in 2019 to induce a recession. So that would leave quite a bit of time, quite a bit of expansion right through 2017 into 2018. What they're suggesting here is that based on the previous times, depending, what happens here, that it would be enough to induce a recession. Real Fed, what we're looking at here, by the way, real Fed funds rate minus the real neutral Fed funds rate. We account for the Fed's balance sheet in our measure of the Fed's policy stance. So we don't know what the Fed will do exactly in terms of their policy here, in terms of their rolling back on QE and their balance sheet. Regardless, it's just interesting to look at, to compare to the previous times, what had happened in those previous recessions, what are the result of their actions, how far they're willing to go on these actions. I mean, this has been unprecedented as of late. And again, what the market expects is that there will be continued expansion, monetary expansion, continued fiscal expansion, continued dramatic effects that seem to be never ending. So I don't know exactly how it's all going to play out, but when I look at these type of things, it makes me want to step back for a moment and regroup and look at my situation, try to take advantage of the situation. If I know that there's going to be a stock market crash, or if I assume that, well, then I probably don't want to have my money in equities. I probably want to look at more safe havens. So I would suggest, maybe something else would be a better idea. Now, I don't have any money in the paper assets to begin with, but if I did, I would start to think, okay, time to revalue or reassess my portfolio. Now would probably be a good time. That's the way I look at it. But there's no telling what the Federal Reserve is capable of. I mean, they could simply ramp up the printing presses today, print off trillions of dollars, hand it off to banks and companies and buy up all the toxic debt around the world, and it would prop up the stock market. There's no doubt. But are you really propping up the value of the market, or are you simply deflating the value of the currency? Well, I believe that it is the latter. That's it for this video. If you found it informative, please give me a thumbs up. Remember that when you give me a thumbs up, it supports this channel. It pushes myself higher up in the YouTube search rankings. So I do appreciate that. And last but not least, if you found the video informative, I know you will find my books, The Money GPS, and my new release, Global Economic Collapse, even more informative. The first book is about the 4 asset classes, talk about the foundation and how to profit from this situation that's going on. Whereas the new book takes the familiar concepts but goes into what I call the Money GPS strategy, and that's becoming self-sufficient, reducing your debt, earning income. So definitely check those out. You can actually flip through the books at Amazon. They have a look inside feature, which will allow you to do that. I'm also on Steemit as well. So check me out on there if you're interested in Steemit. for those who don't know what Steam it is basically a social media platform where you don't have to worry about all of the control and the monitoring that occurs on YouTube. So if you're interested, definitely check me out on there. The links are in the description. Take care.